the US government has threatened to impose heavy tariffs on Japanese goods, while the US dollar has lost some of its global value. At the same time, China and Russia are quietly reinforcing their trade alliance. What are these two superpowers strategically planning behind the scenes? The Trump administration is currently evaluating a proposal to impose tariffs of up to 30% on Japanese imports, particularly targeting automobiles, as a lever to compel Tokyo to increase its purchases of US rice. This aggressive tactic is part of a broader, multi-layered effort aimed at recalibrating the long-standing trade imbalance between the two nations. Japan remains one of the United States' most vital export markets, accounting for nearly 20% of Japan's total export value. Economic analysts warn that if the US enacts a 25 to 30% tariff on Japanese cars, exports could fall sharply, triggering a potential contraction in Japan's GDP by approximately 1.2%, double the projected 0.6 decline if bilateral trade disruptions were limited in scope. The Japanese automotive sector is a cornerstone of the national economy, contributing roughly 10% of GDP and employing nearly 8% of the workforce. A significant tariff shock would strain corporate operating margins, leading to potential cutbacks in production, layoffs, and declines in household income across key industrial prefectures. While Tokyo is widely expected to seek negotiations, possibly aiming for exemptions or mutual concessions, no resolution has been finalized. Until that point, the rising tension casts a long shadow over Japan's export-dependent industries. Heightened trade friction, coupled with rising import costs, could stoke inflation and fuel job insecurity, directly affecting the livelihoods of millions of Japanese citizens. In the first half of 2025, the US dollar depreciated by nearly 11% against a basket of major currencies, marking its steepest annual decline since the 2008 financial crisis. While the S&P 500 index still posted a 5% gain, many foreign investors effectively incurred net losses of around 6% when converting profits back to their local currencies. This highlights a serious erosion of confidence in what has long been considered the world's safest reserve currency. Additionally, the US ISM Manufacturing Index remained below the 50-point threshold in June, signaling contraction for the 33rd consecutive month, the longest streak since record-keeping began. This continued decline illustrates persistent weakness in the industrial sector. Even though a weaker dollar should, in theory, make US exports more competitive, in practice, slowing global demand, political uncertainty, and high financing costs have dampened foreign appetite for American goods. Another concern is the rising money supply in the US economy. In May 2025 alone, M2 money stock increased by 4.5%, pushing the total to 22 trillion USD, according to the Federal Reserve. This excess liquidity, combined with global risk aversion, has pushed investors toward hard assets like gold, real estate, and the euro, further compounding the dollar's downward trajectory. For American households, the consequences are clear. Import prices for essentials, from energy and electronics to consumer goods, are on the rise, stoking inflationary pressures. At the same time, real wages may decline as the dollar weakens. While low-risk savings and investments become less appealing in such an unstable environment, financial markets and the wallets of everyday Americans alike are feeling the strain of this growing uncertainty. Amid ongoing supply chain disruptions and high production costs in the West, the China-Russia trade relationship continues to expand strategically, posing growing pressure on industrialized economies such as the US, Japan, South Korea, and Germany. As of May 2025, Russian exports of aluminum to China rose by 56%, copper by 66%, and nickel more than doubled year on year. These are foundational materials for high-tech industries, from semiconductors and EVs to consumer electronics and defense technologies. This close cooperation has allowed China to significantly reduce production costs, particularly in strategic sectors that Western countries are still trying to protect. In the EV sector, China now controls over 65% of global output and is poised to expand further, thanks to a stable raw materials pipeline from Russia. In semiconductors and electronics, increased access to Russian raw materials is enhancing China's autonomy in final stage production, long restricted by Western control over technology and critical inputs. Meanwhile, the European Union, a major U.S. trade ally, appears to be re-evaluating its economic strategy. The EU's trade surplus with the U.S. in April 2025 reached EUR 7.4 billion, largely driven by exports of automobiles, pharmaceuticals, and machinery. However, with Chinese production costs falling sharply, European companies are facing growing competitive pressure, forcing them to either cut costs or shift parts of their manufacturing base to Asia to preserve margins. The ripple effects are clear. Western manufacturers, from Detroit to Stuttgart, are being compelled to reassess their investment strategies, supply chains, and price competitiveness. For consumers, this could translate to greater variety and lower prices for goods from Asia. However, it also poses real risks of domestic job losses. If Western nations fail to promptly recalibrate their production and trade strategies to fit the emerging global landscape. Overall, the global economic outlook is entering a period of profound transformation, shaped by the strategic maneuvers of major powers. The U.S. is ramping up trade pressure on Japan, particularly in the automotive sector, not just to boost agricultural exports, but also to recalibrate bilateral trade relations, albeit at the risk of pushing Japan toward recession. At the same time, the U.S. itself is grappling with a crisis of confidence in the dollar, which has lost nearly 11% of its value this year, triggering inflation concerns and eroding consumer purchasing power. Meanwhile, Russia and China are quietly cementing a resilient trade alliance, giving China privileged access to cheap, stable raw materials and enabling it to scale strategic industries at a rapid pace, intensifying the competitive pressure on Western economies. These developments underscore a marked shift in the global economic balance, where policy decisions in trade, currency, and geopolitics are now directly impacting production, employment, and living standards across the Pacific. The United States recently imposed a 50% tariff on steel and aluminum from Canada, prompting a series of strong retaliatory measures from Ottawa, including flexible tariffs and a sweeping overhaul of supply chains. Who stands to lose the most in this intensifying trade dispute? In June 2025, the Trump administration implemented a 50% import tariff on Canadian steel and aluminum, citing national security and trade imbalance concerns. While the move was framed as a strategic step to revitalize U.S. manufacturing, its application to a long-standing ally under the USMCA stirred significant backlash. On June 19, Canadian Prime Minister Mark Carney announced a 25% retaliatory tariff on U.S. metal products. Crucially, the policy includes a dynamic mechanism. If no progress is made in negotiations by July 21, the tariff will automatically increase proportionally. This is Canada's first deployment of an open tariff, an innovative approach intended to apply both pressure and leverage while leaving the door open for diplomacy. Canadian officials emphasize that this move aims not at escalation, but at asserting economic sovereignty and defending domestic jobs. According to Canada's Ministry of Industry, over 34,000 jobs in the steel and aluminum sectors are directly threatened by the U.S. tariff action. In addition to hundreds of small and medium-sized manufacturers at risk of shutdowns. At the same time, the U.S. government has remained largely non-committal, Industry stakeholders in both countries are watching closely as tensions mount, with Canada signaling that further retaliatory measures could include regulatory hurdles, port inspections, and non-tariff barriers targeting U.S. goods. The deployment of tariffs by both governments signifies a new, more volatile chapter in North American trade relations. As post-pandemic recovery efforts remain fragile and geopolitical uncertainties persist, the cascading effects of such trade policy shifts are being felt beyond industry, stretching into retail, logistics, labor markets, and consumer confidence. In tandem with its retaliatory strategy, Canada unveiled measures to promote domestic procurement and insulate critical industries. Beginning June 30, 2025, all federally funded projects, including infrastructure, automotive, and defense, must prioritize Canadian-made steel and aluminum, or source from countries with free trade agreements. Federal contracts will be awarded exclusively to compliant suppliers, ensuring procurement dollars stay within aligned markets. Additionally, Canada reaffirmed its dynamic tariff policy. If U.S. negotiations stall past July 21, the 25% duty will rise, establishing clear economic consequences for policy inertia. These measures are designed to incentivize U.S. companies to either localize production in Canada or form partnerships with Canadian firms. That shift would represent a structural evolution of the supply chain landscape across North America. New compliance mandates, including origin audits, import caps, and licensing reforms, require U.S. exporters to retool operations. Many firms will face mounting costs just to remain eligible in the Canadian market. For some, the investment required may not be viable, risking withdrawal from a key export destination. Canadian officials argue that these changes are not only about short-term leverage, but about reinforcing national resilience in the face of economic disruption. By reducing dependency on U.S. imports, Canada aims to build a more autonomous industrial ecosystem, one better positioned to absorb external shocks in future trade conflicts or crises. Meanwhile, the downstream effects are starting to show. In the U.S., costs are already being passed down the supply chain. Cars, home appliances, and construction materials may soon carry price tags inflated by compliance costs, logistical reconfigurations, and raw material surcharges. The repercussions of Canada's trade retaliation are reverberating through key U.S. manufacturing states like Michigan, Ohio, and Texas. In June 2025, spot prices for hot-rolled steel spiked, especially in Cleveland, as firms scrambled to secure supply ahead of a potential July tariff increase. According to the American Iron and Steel Institute, prices reached their highest levels in over a year, driven by speculative buying and supply hoarding. This preemptive buildup reflects deep concern among manufacturers about long-term availability. Producers dependent on Canadian materials are now re-evaluating sourcing strategies, with some turning to more expensive or logistically complex suppliers in Asia or Europe, further inflating costs. In a policy brief, the Bank of Canada estimated that 75% of additional tariff burdens will be passed on to U.S. consumers within 12 to 18 months. That projection portends price hikes for automobiles, appliances, industrial equipment, and even residential construction, heightening the financial stress on American households amid an already difficult inflationary environment. The ripple effects extend to the labor market. Manufacturers and suppliers are warning of job cuts or production delays as operating margins shrink. The National Association of Manufacturers is actively lobbying the administration to consider exemptions for small businesses or essential sectors, or at minimum to resume dialogue with Ottawa. Analysts caution that persistent uncertainty may depress regional investment. Some firms are delaying capital expenditures, wary of being locked into disadvantageous sourcing arrangements or multi-year contracts exposed to future policy shifts. Others are exploring automation and relocation options to offset labor and material costs. The trade conflict between the United States and Canada has evolved into a high-stakes standoff with tangible economic fallout, from Washington's 50% tariff to Ottawa's retaliatory framework and procurement overhaul. The consequences are spreading through steel markets, industrial supply chains, and household balance sheets. What once functioned as a pillar of North American economic integration now stands strained by policy divergence and strategic competition. As the calendar inches toward July 21, the prospect of resolution or escalation will shape not only cross-border trade, but the trajectory of economic resilience for both nations. Walmart, the largest retailer in the United States, is currently facing unprecedented challenges as it proceeds to close multiple stores and reduce its workforce by several thousand employees, largely due to pressure from newly enacted tariff policies. Can the nation's supply chains and consumer prices stabilize in the near future? Amid the implementation of new trade tariffs, Walmart has announced plans to close a number of stores and cut approximately 1,500 positions across its global technology, e-commerce, and advertising divisions. This move is part of a broader restructuring strategy aimed at simplifying operations and addressing the growing challenges facing the retail sector in the current economic climate. The closure of stores and workforce reductions not only affect employees, but also have ripple effects on local communities, especially in rural areas, where Walmart often serves as a major employer and a primary provider of essential goods. With tariffs on imported goods reaching as high as 145%, Walmart has experienced a significant increase in import costs. In response, the company has adjusted its retail prices to offset these expenses, resulting in a 20 to 30% increase in the cost of essential items such as food, household goods, and electronics over the past few weeks. Consumers, particularly those with lower incomes, are feeling increased financial pressure as the cost of everyday necessities continues to rise, placing strain on household budgets and impacting overall quality of life. The closing of Walmart locations affects more than just the company's direct employees. Local businesses, such as restaurants, gas stations, and laundromats, that depend on foot traffic generated by Walmart, are also experiencing declining revenues. As communities lose access to a key retail hub, residents are forced to travel farther for basic shopping needs, while facing reduced services and fewer amenities within their neighborhoods. To adapt to current conditions, Walmart is accelerating its adoption of automation across retail operations, including the use of robotics, artificial intelligence, and automated checkout systems. Additionally, the company is shifting its supply chains from China to other countries such as India, Vietnam, and Mexico to mitigate risks associated with tariff policies. While these measures allow Walmart to maintain operational continuity, they also result in lower demand for labor, ultimately affecting job opportunities in local markets. Beyond the retail sector, industries such as automotive, aerospace, and defense are also grappling with the effects of recent tariff measures. Disruptions in the availability of imported components and raw materials have led to temporary factory shutdowns, impacting thousands of jobs and causing delays across global supply chains. Workers in these sectors are facing heightened uncertainty about job stability, while consumers may continue to encounter elevated prices and product shortages in the marketplace. America's steel sector is experiencing significant challenges due to recent tariff policies, leading to job losses and increased costs. How are these developments affecting the daily lives of American workers and consumers? The U.S. steel industry is encountering financial setbacks, with United States Steel Corporation reporting a net loss of $116 million in the first quarter of 2025, a reversal from a $171 million profit in the same period last year. This downturn is attributed to increased tariffs on steel imports, which have raised production costs and reduced competitiveness. Recent developments have led to significant job losses in the U.S. steel industry, with over 1,200 layoffs at Cleveland Cliffs facilities in Michigan and Minnesota, and a workforce reduction of approximately 900 employees at Granite City Works in Illinois. These figures underscore the broader challenges facing steelworkers and related sectors amid shifting trade policies. The implementation of higher tariffs on imported steel has resulted in a cost spiral for American manufacturers. Companies face the dilemma of absorbing increased costs, raising prices, or reducing their workforce to maintain profitability. Households are now paying more for everyday goods, including cars, washing machines, and even basic home repairs. For middle-class families already battling inflation, these added costs are particularly painful. Older Americans planning home renovations or car replacements are finding themselves postponing purchases, further slowing demand. In some areas, price hikes of 10 to 15% have been recorded for key goods tied to steel inputs, putting added strain on fixed-income retirees and working families alike. Major automotive manufacturers like General Motors and Ford are scaling back production and delaying new model releases in response to increased steel costs. Ford has temporarily halted operations at certain facilities, and Harley-Davidson is considering relocating some production overseas to mitigate expenses. These corporate decisions have real consequences for workers on the ground. Thousands of auto employees, many in the Midwest and South, face furloughs or job uncertainty. With fewer vehicles rolling off the lines, car dealerships are reporting shortages, pushing prices higher. This directly affects families needing affordable transportation, a particular concern in rural and suburban areas, where public transit is limited. The broader economic impact of these tariffs includes a projected decrease in GDP growth. Goldman Sachs has revised its 2025 GDP growth forecast down to 1.7%, from an initial 2.4%, citing the adverse effects of rising tariffs. This slowdown is particularly hard on older workers, who are often the first to be cut during industrial restructuring. As job opportunities contract and wage growth stagnates, many households are dipping into savings or delaying retirement. The prospect of long-term unemployment is rising in industrial towns, while younger generations may be discouraged from pursuing careers in manufacturing altogether. For a country that once built its middle class on factory floors, the current trajectory is raising fundamental economic questions. Canada is fast becoming the new trade favorite across Asia, Europe, and beyond. While U.S. tariffs are reshaping retail and jobs at home, is America losing its edge without even noticing? While the U.S. imposes tariffs as high as 50% on steel, aluminum, and cars, Canada has quietly signed new trade pacts with Asia, Latin America, the EU, and India. Its latest agreement with Indonesia slashes 90% of bilateral tariffs, boosting sectors like electronics, minerals, AI, and advanced manufacturing. Canada's Indo-Pacific strategy, backed by a $2.3 billion initiative, is rapidly expanding its presence in the region and attracting new investment. As Canada strengthens its global partnerships, the U.S. risks losing key trade leadership. This could mean fewer job opportunities, less investment, and higher consumer prices as American influence in global markets wanes. A sharp 125% tariff on goods from China has hit U.S. retailers hard. Walmart, Target, and Dollar Tree have raised prices on essentials like electronics, toys, coffee, and flowers. According to Yale's Budget Lab, American families now spend an extra $4,900 per year just to maintain their standard of living due to rising costs from tariffs. Walmart appealed to the White House for relief, but was denied. Meanwhile, Amazon Canada is thriving with lower prices and faster delivery to U.S. shoppers. Consumers face rising costs and product shortages, while retail workers deal with job cuts. As cross-border shopping from Canada increases, domestic distribution networks face serious disruption. Canada is emerging as a central player in the global supply chain through new deals with the EU, Japan, Australia, and India. Ottawa-based corporations have voiced concerns over U.S. isolationism, stating, "We cannot let the U.S. self-destruct and drag us down." Canada is also ramping up capabilities in battery metals, rare earth minerals, and clean energy, drawing manufacturing orders and capital away from the U.S. High-tech job growth is shifting northward. American workers in steel, automotive, and battery sectors face job insecurity, while U.S. firms increasingly rely on imports from Canada, rather than serving foreign markets directly. Analysts warn that unless U.S. trade policy changes course, the economy could face a triple threat: high prices, supply shortages, and rising unemployment. Canada's growing web of trade alliances is creating a parallel system that excludes the U.S., attracting international businesses seeking stability and predictability. Workers, small businesses, and the middle class are bearing the costs of current trade strategies. Without adjustments, America could fall behind as global commerce evolves without it. America's auto industry is facing an unprecedented challenge as new car inventories hit record highs and consumers walk away from new vehicles. With dealerships struggling and car prices soaring, could this crisis permanently change how Americans think about car ownership? As of May 2025, U.S. new vehicle inventory has surged to over 2.84 million units, with an average 80-day supply for EVs, SUVs, and luxury models. It exceeds 100 days. Dealerships in Texas, Arizona, and Michigan are cutting staff, downsizing, or seeking foreign buyers, signaling a major industry shift. The sudden glut of unsold cars has left hundreds of thousands of dealership employees at risk of losing their jobs. Local communities are seeing a sharp drop in tax revenue and economic activity, putting public services and small businesses in jeopardy. For many towns that rely on auto sales as their economic lifeblood, this downturn means real hardship for families, workers, and local governments who are struggling to adapt to the new reality. In 2025, the average new pickup costs $54,000, up from $38,000 just 6 years ago. Auto loan rates now average nearly 10%, with some buyers paying 15 to 22% due to imperfect credit. A $24,000 loan on a $32,000 car can mean $650 monthly payments, more than many mortgages. As a result, Americans are keeping older vehicles, often with over 200,000 miles, to avoid unsustainable debt. With soaring prices and sky-high loan rates, millions of Americans are forced to drive aging, high-mileage cars. This trend brings more breakdowns, higher repair bills, and growing safety concerns. The stress of mounting financial pressure is eroding consumer confidence, especially among the middle class, who now feel shut out of the dream of new car ownership. Electric vehicles and luxury SUVs now comprise a growing share of the over 750,000 vehicles unsold for more than 100 days. Despite EV price cuts of up to 50%, buyers remain scarce as they sit unused. Batteries degrade, tires crack, and paint fades, turning them into liabilities for dealers and automakers. Major automakers like Ford, GM and Stellantis have cut production by 35 to 40%, causing tens of thousands of layoffs. The rapid depreciation of new technology has shaken public trust in electric vehicles. Many Americans are now hesitant to embrace modern cars, fearing their investment will quickly lose value. The dream of a green automotive future feels more distant, while the risk of job loss in manufacturing communities has grown. As car makers cut orders, parts factories in Ohio, Michigan, and Tennessee are shutting down. Over 50,000 auto jobs have been lost in just 6 months, per Bloomberg and the Wall Street Journal. The ripple effects reach banks, pension funds, credit unions, and school budgets. Entire communities, from teachers to grocery store owners, are being swept up in the crisis. As the auto industry's decline ripples through the local economy, small towns are losing their industrial identity and facing the prospect of long-term poverty. Job losses are undermining the stability of families and neighborhoods.